Have you ever seen people making money from the stock market and wondered how they are actually doing it? Maybe you have heard stories of someone who invested early and became financially free, and somewhere in your mind you thought that sounds great. But it is not for me. It feels risky, confusing, and maybe even a little intimidating. But what if I told you that the stock market is not as complicated as it looks from the outside? In fact, once you understand the basics, it becomes one of the most powerful tools to grow your money over time. And in this video, I am going to explain everything in a simple, practical, and human way so that even if you are a complete beginner, you can understand how it works and how to start. No complicated terms, no confusing strategies, just clear and useful knowledge. So let's start from the very beginning. First of all, what is the stock market? Imagine there is a company that is growing and wants to expand its business. Maybe it wants to open new branches, launch new products, or enter new markets. For all of this, it needs money. Now, instead of taking a loan from a bank, the company decides to raise money from the public. It does this by dividing its ownership into small parts and selling those parts to people. These small parts are called shares or stocks. So when you buy a stock, you are not just buying something on a screen. You are actually buying a small piece of that company. That means if the company performs well and grows, the value of your share increases, and if the company struggles, the value can go down. The platform or system where all these shares are bought and sold is what we call the stock market. Now the next question is, why do people invest in the stock market in the first place? The simple answer is growth. If you keep your money in a savings account, it is safe, but it grows very slowly. In many cases, it does not even beat inflation, which means over time, your money actually loses purchasing power. On the other hand, when you invest in the stock market, your money gets the opportunity to grow faster. Historically, markets have gone up over the long term, and this growth helps people build wealth. Of course, this does not mean there is no risk. The stock market goes up and down, and that is completely normal. But if you understand what you are doing and stay consistent, the long-term benefits can be very powerful. Now, let's talk about how people actually make money in the stock market. There are mainly two ways. The first is through price growth. For example, if you buy a stock at $100 and after some time the company grows and the price becomes $150, the difference is your profit. This is the most common way people earn from stocks. The second way is through dividends. Some companies share a part of their profits with their investors, so even if you do not sell your stock, you still receive a portion of the company's earnings. This creates a passive income stream over time. But what causes stock prices to move up and down? This is where many beginners get confused, but the concept is actually simple. Prices move because of demand and supply. If more people want to buy a stock, the price goes up, and if more people want to sell, the price goes down. But what influences this demand and supply? Several factors, such as the company's performance, news, industry trends, overall economic conditions, and future expectations. Sometimes even a rumor or a small piece of news can impact prices in the short term. That is why you will see markets going up and down every day, and that is completely normal behavior. Now let's understand the types of stocks in a simple way. First, there are growth stocks. These are companies that are expanding quickly and reinvesting their profits back into the business, so their stock price increases over time. Second, there are dividend stocks. These companies regularly share profits with investors, making them suitable for people who want steady income. Third, there are blue chip stocks. These are large, well-established companies with a strong track record. They are generally more stable and less risky compared to smaller companies. For beginners, it is usually better to start with strong and stable companies instead of chasing risky opportunities. Now let's talk about one of the biggest mistakes beginners make. Most people enter the stock market with the mindset of getting rich quickly. They see someone making quick profits and think they can do the same. So they start following random tips, investing without proper understanding, and reacting emotionally to every market movement. When the market goes up, they feel excited and invest more without thinking. And when the market falls, they panic and sell at a loss. This cycle leads to frustration and losses. The truth is, the stock market is not a shortcut to instant wealth. It is a long-term game that rewards patience, discipline, and consistency. So how should you actually start investing? Let's break it down step by step. First, focus on learning the basics. You do not need to become an expert overnight, but you should understand what you are investing in. Second, start small. You do not need a large amount of money. Even a small investment is enough to begin your journey. Third, choose good quality companies with strong fundamentals. Look for businesses that have a clear model, consistent performance, and growth potential. Fourth, stay consistent. Instead of trying to time the market, invest regularly over time. And finally, think long-term. Do not expect instant results. Real wealth takes time to build. Another very important concept is risk management. Never invest all your money in one stock or one idea. Always spread your investment across different companies or sectors. This is called diversification, and it helps reduce risk. Also, only invest money that you do not need immediately. The market can be unpredictable in the short term, so you should be mentally prepared to hold your investments even when prices fluctuate. Patience is not just important, it is necessary. Let's understand this with a simple, real-life example. Imagine two people starting their investment journey. The first person keeps chasing quick profits, jumping from one stock to another based on tips and trends. The second person takes a different approach. He invests in good companies, stays consistent, and ignores short-term noise. After a few years, the difference becomes clear. The second person builds steady and meaningful wealth, while the first person struggles with inconsistency and losses. The difference is not intelligence or luck, it is discipline and mindset. Now let's talk about something that is often ignored but extremely important, and that is emotional control. In the stock market, your biggest enemy is not the market itself, but your own emotions. Fear and greed are the two emotions that drive most bad decisions. When the market falls, fear makes people sell at the worst time, and when the market rises, greed makes them invest blindly. Successful investors learn to control these emotions. They do not react to every movement. Instead, they follow a plan and stay focused on their long-term goals. Speaking of long-term, this is where real wealth is created. The stock market will always have ups and downs, and that is completely normal. But if you keep entering and exiting frequently, trying to predict every move, you will most likely lose. On the other hand, if you stay invested in good companies, and give your investments time to grow, you benefit from compounding and long-term growth. This is how most successful investors build their wealth over time. Here is a mindset shift that can completely change your approach. Stop thinking like a trader and start thinking like a business owner. When you buy a stock, you are buying a part of a company. So ask yourself, would I be comfortable owning this business for the next 5 or 10 years? If the answer is yes, then short-term fluctuations should not bother you. This simple shift in thinking can help you stay calm and make better decisions. Let's also talk about consistency, because this is where most people fail. Investing once or twice will not make a big difference, but investing regularly, even small amounts, can create a huge impact over time. This is because of compounding, where your returns start generating their own returns. In the beginning, the growth might look slow, but as time passes, it starts accelerating. This is why starting early and staying consistent is so powerful. Now you might be thinking, what if I make mistakes? The answer is you will. Everyone does. Even experienced investors make mistakes. The goal is not to avoid mistakes completely, but to learn from them and improve. Start small so your mistakes are manageable. Focus on learning, and over time, your confidence and understanding will grow. Let's bring everything together in a simple way. The stock market is not gambling if you approach it with knowledge and discipline. It is a tool, a powerful tool that can help you grow your money and build financial security. But like any tool, it needs to be used correctly. You need patience, consistency, and the right mindset. So if you are a beginner, do not feel overwhelmed. Everyone starts from zero. The important thing is to take the first step. Start learning. Start small and stay consistent. Do not chase shortcuts or quick profits. Focus on building a strong foundation. And remember this, time is your biggest advantage. The earlier you start, the more you benefit from compounding and long-term growth. Even if you feel like you are late, you are not. The best time to start was yesterday, and the next best time is today. So do not wait for the perfect moment. There is no perfect moment. Start with what you have, learn as you go, and keep improving. Over time, your small steps will turn into big results. And one day you will look back and realize that starting early, staying consistent, and thinking long-term was one of the best decisions you ever made.